It's been a rough week for tech and the Magnificent Seven to begin the year. The Nasdaq has been down 4 straight days to begin the year. Jim Cramer said it's time to take profits in last year's big tech winners. Cramer recently trimmed some big tech holdings in his CNBC Investing Club's charitable trust, but admitted that it was not an easy decision. Jim said that profit taking is important, even if it's hard to let go of some winning shares.
That thing called the yield curve. On days like today, though, where the Dow tumbled 285 points, S&P lost 0.80%, the Nasdaq sank 1.18%. These concepts come into play, and you got to understand them. First, we must always remember that the bond market is much bigger than the stock market and much more significant. U.S. Treasuries are the most important bonds in the world because they're deep, meaning they're very large markets for all levels of U.S. debt, and they're backed by the full faith and credit of the United States government, which still matters despite the fact that the Uncle Sam is $34 trillion in debt. Despite that humongous Treasury issuance, all other bonds are priced off them, meaning the companies with the best balance sheets can issue bonds with just a little more in yield to attract buyers. Less healthy companies have to pay more for their debt, and the least healthy companies struggle to get financing at all. But beneath bonds in the pecking order of yield are the returns that come from common stock dividends that we talk about all the time. Unlike treasuries, dividends are the opposite of risk-free. A dividend can easily be canceled the moment the company has financial problems. Unlike bonds, they have zero obligation to keep paying that money. So why am I going into the soporific world of fixed income? Yeah, because I want to explain to you what the heck is going on with the stock market right now, and I can't do that unless you know how important higher-yielding dividend stocks are at this moment versus stocks that offer little or no yield. And when I talk about little or no yield, I mean stocks like the Magnificent Seven and their fellow traveler enterprise software plays. Why bring up the distinction? Because ever since October 23rd, the day that long-term interest rates peaked, higher-yielding dividend stocks have been flying, while the Magnificent Seven have fallen behind. Now, for most of last year, this market was led by the Mag 7. But ever since rates peaked, no, they've lost their leadership. I want you to do this. I want you to consider the disparity between the performance of the S&P 500 with each member's stock equally weighted rather than market cap weighted. In other words, every stock's equal in size versus the Magnificent Seven. See, ever since rates peaked, confirmed by the Fed's following decision to stop tightening short-term interest rates, which is, of course, the one it controls, look at what happened with the equal-weighted S&P 500. This is the version of the S&P where Apple and Microsoft have the same weighting as all the other 498 stocks. The equal-weighted S&P has beaten the Magnificent Seven index by 13.4% to 11.2%. That's 223 basis points, as the money managers would say. That's right. The leader for the last couple of months hasn't been the Magnificent Seven. Those stocks are underperforming the equal-weighted S&P 500 by what the pros would say is actually a significant margin. If you stuck with the 7 and your money manager, you actually lag behind the more pedestrian equal-weighted index that makes the 7 equivalent to the rest of the Lilliputians. Why is that? Because the market broadened away from the 7. Once interest rates peaked, investors started warming up to stocks that have dividend yields that might be less puny once we get rate cuts that we are expecting. More on that in a moment. What's working? Well, all sorts of other stocks. As you can tell from the performance of the equal-weighted S&P 500, some of it's the banks. J.P. Morgan, for example, went from 141 to its highs, actually all-time high in the 170s. Yeah, a bank stock beating the Magnificent Seven. Can you believe it? That's because it's going to be a big winner when it comes to earnings now that rates have peaked, and it offers a higher yield than the 7 when it comes to income. It's not just J.P. Morgan. Bank of America has gone from 25 to 33. Wells Fargo, 39 to 48. Utility stocks roared. Same with real estate investment trust, pipelines, some higher yielding retailers. Many economically sensitive industrials, they all outperform the Magnificent Seven. What does this disparity tell us? Frankly, it says nothing about the 7 itself. Those are still great companies. This is all about Wall Street's new consensus view that interest rates will keep coming down, making dividend stocks more valuable. I don't want to just cite this S&P equal-weighted index as part of the new winners, though. There are other cross currents. Big institutions are making sizable bets on healthcare, which is usually a sign that someone's very worried about a sudden slowing in the economy, perhaps because the Fed may not cut enough or fast enough, or maybe not cut at all. Well, at least not aggressively. And I see this healthcare bet as making some sense, which is why we continue to own Eli Lilly for the Travel Trust. It's best performing drug stock thanks to its revolutionary diabetes and weight loss drugs. Many of the drug stocks like AbbVie, GSK, and Merck, they're all having almost parabolic moves because they're both sensitive to the economy and pay large dividends. I don't like parabolic moves, you know that, because that often means you're late to the party. But the performance is so stark versus the Mag 7, you got to recognize these stocks have become the new darlings that are bubbling the surface while the 7 have kind of stalled out. Now, you might ask, who has the money to buy all these other stocks and these indices? Where's it coming from? Again, the answer's right in front of you. The money's coming out of none other than the Magnificent Seven itself, especially from Apple, but also from Tesla and Nvidia. These stocks are acting as what's known as sources of funds, meaning portfolio managers are selling them in order to raise money so they can invest it in other places. At the moment, they're putting it in the dividend stocks and healthcare. That's why I say it's a rotation. Money going from one part of the stock market into another. And it's happening rather mindlessly as the high yielders aren't even that high yielding anymore. Doesn't matter. When rates come down, these stocks will go higher still. When you look at that move since the bottom in October, though, you know that investors acted well ahead of events. That market, well, it anticipated everything that's happening. What does all this tell us about your portfolio? I think it's clear. The market has momentarily fallen out of love with the Mag 7. While there'll be pockets of strength on any given day, more on that later, the money's headed away from a small group known for its magnificence to a much larger group of 493 prosaic stocks, as well as the Russell 2000 small cap stocks that have been kept down because of fears of recession, fears that diminish because of the Fed's deft handling of the economy. Don't worry, the 7 will eventually return to their rightful place, but not until the rest of the market catches up with them, or if the rest of the market and everything else falls, but the rest of the market doesn't fall harder than the Mag 7. Bottom line, this is a new market. That's right, where the mega cap techs are no longer the leaders. It's a market where money is being put to work at a lot of boring, higher yielding stocks, as well as smaller caps, healthcare, banks, REITs, and utilities. Right now, though, we got real profit taking coming on the heels of last year's big finish, causing us to continue our more cautious tone on Mad Money and with the charitable trust. Not putting money to work into this weakness, not just watching and waiting with a lot of cash for much better prices. How about we go to Scott in Ohio? Scott!
Hey there, Mr. Cramer. How are you tonight?
I am doing well, Scott. What's up with you?
Hey, not much, man. Hey, prior to the pandemic, which devastated the entire travel and tourism industry, I invested quite heavily with Carnival Cruise Lines.
Okay.
And I was wondering, do you see they have the leadership to get restored back to pre-pandemic limits?
Okay, look, I think that they're good. I am more focused, frankly, on Royal because they've got a better balance sheet. But I think you're fine. And the reason I say that is because cruising is a great bargain, and people always come back to that. We said that at the height of COVID, and we're sticking by it. But Royal Caribbean is the one that looks the best right now. How about Randy in New York? Randy.
Hey, Jim. I want to thank you for everything. My wife and I, we watch you every morning at 9, and then we join you with the meeting at 10:20 every day.
Yes!
We love it.
You're like my sister Nan's friend that she bumped into who loves what we're doing. How can I help?
We do. You've been talking about discipline a lot lately, and I get it because, yeah, I've been burned by being a pig too often. But I did trim some of the giants that I made money on the end of last year, but I got to Google, and something is on my shoulder saying, don't trim it yet. And it's not dominating my portfolio.
Understood. I understood. But here's the problem, Randy. You know, I trimmed all of them for the trust because they're too big. And we've had too much of a run. Google in particular, I'm worried. If Google Cloud Services doesn't come back, that stock is going to stall out. I am more concerned about Google than I am for any of the other of the Magnificent Seven, frankly. How about Vidya in Texas? Vidya.
Hey, hi, Jim. How are you?
All right. How about you?
I'm good, sir. Thank you. So thanks for taking my call. I have been watching the show for a long time, and it is so insightful. I have a question for you on PayPal. I have been holding the stock for past 2 years, and there was no much traction on the stock price. Should I continue to hold the stock or sell it off?
I got to tell you, this guy, Alex Chris, who's running the company, Intuit, he's a winner. I haven't been behind PayPal for a long time. I think this guy, if he delivers a good quarter next, then we will know that PayPal is back and bigger than we expected. And again, to Randy with Google, look, Google's not expensive, but I am concerned. That's why we had to take a little schnitzel. We were being greedy. Magnificent Seven are no longer the leaders in this market. We got to accept that. Instead, the money's going into high yielders and some banks and some drug stocks, healthcare, REITs, you bet. I think that all this is going to keep happening and that the Mag 7 is going to stall. It's just not where you want to be. That's why we trim some of them. On Mad Money tonight, is it time to trim your winners after 2023's big run? I'm looking at last year's S&P 500 standouts for a sense of what 2024 has in store. And it's not all about the winners. I'm digging into the stocks that were at the bottom of the barrel in the S&P 500 too, and I see some things I like. Don't miss my takeaways. Plus, has the market's heightened expectations on interest rates sprinted too far ahead of reality? I'm reading those tea leaves for you, so I can tell you what I think is going to happen with the upcoming Fed action. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.